Hello, everyone. Um, we are going to get started here in just a moment. I'm going to allow everybody to go ahead and get logged in before we get started. Good to see some familiar faces and some, well, names and new names as well joining us this morning. Excellent. All right. Well, let's go ahead and get started. It looks like we got quite a few people that are logged in already. Thank you so much for joining us and welcome to Webinar Wednesday special edition on a Thursday. We felt this topic that Jim is going to cover today was really important and we didn't want to push it off any longer with all of the craziness that's happening in our markets today. So today, Jim Weigel is going to be talking to us about, is your cash safe? But before we get started, I do have a few housekeeping items to cover. This webinar is being recorded, just like all the other webinars we do, and we leave them up on our website so you can watch them at any time. They're always free. Today, so since it is being recorded, we are going to record that. It'll be available this afternoon so you can share with friends and colleagues if you like. Since we're trying a new format, we are doing a short presentation followed by a question and answer period. So now more than ever, we'd love to see your questions in our question box. So down at the bottom of your screen, there are two speech bubbles with the Q&A underneath that. Please feel free to ask questions as we're going through the presentation. It should only last about 15 minutes. And then after that, we're going to go through all of your questions. This is kind of a meaty topic, so we're happy to help answer any questions that you have. And of course, if you have any other issues or technical issues that you need help with, you can reach me directly with the chat bubble. That's a single chat bubble down at the bottom with the word chat underneath that. And I'm happy to help you in the background if you have any other questions. Our presenter today is Jim Weigel. He specializes in helping builders implement effective management systems with a focus on discipline, leadership, and performance excellence to increase revenue. His areas of expertise include management, marketing, sales, finance, quality, valuation, and owner transition. He also spent time as a banker. So this topic that we're talking about today is a little bit closer to his heart than most of us. So with that, I'm going to go ahead and pass it over to Jim to go ahead and get started.
Thanks, Emma Jane. That's funny because I actually left banking for a reason because I really got sick and tired of it. But and wanted to get into the home building business. But let me I'll talk about that in just a moment. Where we are right now is that short-term interest rates over the past year and a half have gone from almost zero to over 4%, touching 5% most of the time for 3 to 6 month money. And so homeowners are seeing their mortgage rates at 6.5% to 7.5%. And we don't see this yet. Or we see it, but we don't really act on it a whole lot. But money market yields are over 4%. So we can get at least 4% on the cash that we have laying around. And what we don't really see, unless we've invested in this much, is that the value of bond portfolios are down at least 10%, and those longer-term mortgage-backed securities, they're down 20 to 30% from where they were a couple of years ago. And so what happened is that there's been some bank runs on a few banks and a couple, 2 or 3 failures, and all kinds of liquidity backstops that the Federal Reserve has kicked in over the past weeks. And the reason why I've noticed this and paid attention to it, because I started in the banking industry in 1979, and I was as a credit analyst. And I would work for all kinds of different lenders in different industries. And one of the groups that we made loans to were banks. We would make bank stock loans to people who owned banks and bought them, and we would provide credit lines to banks as well. So we had to analyze them all the time. There were probably 10,000 banks back then, and now there's about 4,700 banks. So that's my experience with mainly not as a commercial lender and real estate lender, but more analyzing the financial condition of banks. That's not my expertise in detail these days, but the basics haven't changed. And so I'm going to talk a little bit about how you can do some of the basics and then if people are interested in learning that more, then maybe we can offer something in more depth. So here's what happens. Two banks failed: Silicon Valley and Signature Bank. Signature is in New York, Silicon Valley in California, and they are the two biggest bank failures this century. So Washington Mutual in the great financial crisis was the biggest bank failure, actually in all time. And if you combine Silicon and Signature, they were bigger than that. And they happened all at the exact same time on a Friday about 3 weeks ago, I think. So we don't hear the magnitude of that much, but to me, that's a big deal. We should not be seeing relatively large banks fail. Now, this has been the backdrop for this is that deposits have been declining since about a year and a half, 2 years ago now. So they started declining really last year. They've been going down ever since. And the reason for that is that people have had to spend their money. And if you can notice this as well, the difference between that more tan line and the blue line is the uninsured deposits. So uninsured deposits typically have made up about 55% of banks' deposits. So it's not unusual for them to have a lot of the people who deposit money over $250,000. That's a very common thing. But overall, all kinds of deposits, especially uninsured deposits, increased over the past several years because all that money was available through the COVID times and initial public offerings of tech companies and other companies as cash. But they've been spending that money. So everybody's been spending that over the past year and a half, and so those deposits are going down. Businesses are spending it to run, pay for their expenses and their people. Every individual household and family is spending it on higher prices for everything. So all of those extra prices and expenses are causing deposits to drop. Now they're starting to drop even more because the yields you can get on your money have changed. So if you look a year ago, year and a quarter ago, interest rates were really low. They were 0% for under 0.5%. They weren't worth paying any attention to for short-term money. And that had been going on for over a decade. So we got in the habit of not paying attention to our money in the bank because we couldn't really make any money on it anywhere else. So there was no point to it. Well, look what's happened even in the past year. Now you can make 4.5% to 5% regularly just by tying your money up for on average 3 to 6 months. So, and also notice that the long end of that, those 10-year treasuries, went from about 1.5% a little over a year and a half ago to now they're 3.5%. And that's what mortgages are priced on. So you add three points to that, and that's normally what a 30-year mortgage is. So that's what's caused the problems and the opportunities, not only in mortgages for our customers, but in the problems for the banks as well, and opportunities for us if we've got cash balances. So let me just summarize a little bit about what happened with Silicon Valley Bank. The value of the U.S. Treasury bonds and their mortgage-backed securities that they were holding to maturity. They were buying these 30-year mortgage-backed securities, and they were planning to hold it for the life of those loans. But they had unrecognized losses because their interest rates rose. So for every 1% that interest rates rose, the value of their portfolio was dropping about 10%. And as we saw, interest rates rose 20%, or they rose 2 points. So the value of their portfolio went down about 20%. They also had a whole bunch, way beyond the norm. Substantially more than half of their deposits were over $250,000 per account. And so those folks were starting to spend their money because they were in the tech business and they weren't bringing in the revenues. And then they started accelerating their transfers out because they could make more money on U.S. Treasury bills. And then the last few days, they were accelerating that out in hours. So as the bank was losing deposits over the past month or two, were selling their Treasury and mortgage-backed security portfolio and recognizing some of those losses, which was eating into their equity. So they couldn't raise enough equity to cover those losses, and then they just lost a whole bunch of money, $40 billion in less than a day. So the FDIC, the Federal Deposit Insurance Corporation, closed the bank on Friday morning, and on Sunday, they surprised almost everyone by agreeing to cover the uninsured deposits too. So people who had over $250,000, people who had multiple millions of dollars, whether they're foreigners or U.S. residents, they got their deposits covered as well. And that tended to stabilize what was going on in most of the mid-size and smaller banks. Although banks lost a lot of deposits. Big banks gained about $120 billion of deposits, it looks like, and that means the top 25 banks. And all the other banks lost about $100 billion of deposits. So it's still going on. People are still moving money into the larger banks. But that's not really the answer. Just to think that these larger banks are too big to fail, so that your money is always safe. Even banks with insured deposits can fail, and that causes delays and inconvenience. It really causes stress and waking up at night, and so that's a problem. That's why everybody's worried about it. Now, the good thing is that really 95 to 99% of those 4,700 banks are completely safe from this standpoint. They were doing the right thing. They didn't have a whole lot of long-term mortgages. Their loan portfolio is still pretty good. And we'll talk about a little bit more about what they're doing right now, because it's going to have some effect on people who are borrowing from banks as well. A lot of people, one of the simplest things you can do is, if you're worried about money that's not insured, you just have more account holders. So you can create, so if you got more than one entity, you can create an account for every entity, and each one is insured up to $250,000. Or you can put the money in other banks and have that insured as well. And some banks are even offering services where they will do it automatically for you. They'll automatically put that money in other banks and save you that administrative hassle. However, that doesn't solve the problem of things. Maximizing a really safe yield, because most banks are not going to pay you what a 3 to 6 month Treasury bill is. They're not going to pay you 4.5% to 5%. Maybe they're paying you 3 to 4% now. And you're also not diversifying your risk. So even if you're keeping all your money in the banking system with other banks and having $250,000 of deposits, you're not diversifying outside of the banking system. So we'll talk about that a little bit. So one of the first things we want to do is determine the safety of our bank. And I'm just talking about safety from a financial condition standpoint. And it's really easy to do. You look up the summary and their call report. They publish those to the government every 90 days. They have to publish their call report, and that information gets updated. And anybody can look it up. You just go to that website and you start looking up your bank, and you can find this information. I'm not going to go through the details of how to analyze a bank statement, except a few simple pointers but there's one thing in particular I'll talk about in a couple slides that makes it really easy to do. So we're going to examine the basic information that exists there. We're going to look for, here's a few specific ones, because most banks actually make loans. That's how they make money. They take in deposits, and then they make loans to people in their community. And so we want to look at what's going on with their losses, their past due and non-accrual accounts. That tells us what's going on with the quality of their loans. And if we want to evaluate their uninsured deposits, if we're concerned about that, go to the deposit insurance and assessment schedule that they have in there as well. And then we want to see, do they have a lot of long-term securities in this held to maturity account that has losses on it? So we wanted to see, do they have that? Almost every bank does not have that. Only really big banks tend to invest a lot in long-term securities, and even there, it might be a large dollar amount, but it's a very small percentage of their overall assets. So Silicon Valley Bank, for example, move out of the way so I can actually read this. They had $15 billion of equity and a little over $200 billion of assets. So that's kind of normal, around 7%. But they had $91 billion of held to maturity securities, treasuries and mortgage-backed securities, which is a really big number. I mean, that's 45% of their assets. That's huge. Hardly anyone ever has that amount. And what makes it even worse, they paid $1 billion for those, but it's only worth $76 billion because those interest rates had gone up, and they bought them when interest rates were 1.5%, and now they're 3.5%. So they had lost, $18 billion really is how much they lost on that. Their loans and leases were just fine. And the reason why is that they got a whole bunch of deposits over the past 3 years. They basically more than doubled their asset base in the past 3 years, and they were fairly careful in not increasing their loans. But what they did is they took money and invested in 30-year mortgage-backed securities, but the money that was backing that up, people could take out in a minute. So that was dumb. That was highly risky and very unusual for any bank to do. So what happened was that as soon as that $18 billion of losses they had in held to maturity securities wiped out their equity. And so that's why the Federal Reserve had to take them over really quick, because they just didn't have any equity that made sense. And what bothers me about this is that the Federal Reserve, the FDIC, they knew or should have known about this and did not take any action to enforce a more safe financial condition for Silicon Valley Bank. That's what bothers me the most about this, and that's why I'm suggesting each of us has to pay a little bit of attention every 3 months to every year to our bank and ask them some questions based on the financial information they submit to the regulators. And here's all you got to do. You print off that information from the call report and the executive summary and any of those others that are in there. And you take that to your banker and you ask them, what are the significant line items that we have to pay attention to? And what do they mean? And if any of them have changed significantly, and that means plus or minus 10%, why have they changed? That's one of the biggest things when it comes to a bank is changes. Significant changes in assets, in income, in losses. That's the biggest deal, is something that changes significantly from one quarter to the next or one year to the next. And that's all you have to do is ask them to explain it. Because if they can't explain it clearly to you, then they don't understand it either. And most bankers on the retail side, they don't know about it. But most bankers who run a bank, especially in the smaller banks, they really what's going on with their bank financial statements, and they can explain it well, and they can explain what's going on in the rest of the banking world. So if this is just a basic review, if we want to learn about it in more details to how I do it, it doesn't take me more than a few minutes per quarter to look at a bank, no more than 15 minutes, even the most complicated banks. And I don't understand some of the most complicated ones, so that's why I don't have a whole lot of money in even the real big banks either. So if you want a more thorough review, contact a qualified registered investment advisor. There's also bank stock analysts. My favorite group is the Keith Bruyette Woods. They publish the KBW Bank Index. They've been doing it for decades, so they really know how to analyze a bank. The next solution that we need to work out is diversify and increase our yield. I think a lot of folks have their financial advisors through the banks, and there's nothing wrong with that if you trust them. But to me, I want someone who's independent. I want someone who knows their business. So I always look for a registered investment advisor who's a fee-only person, and so their only interest is your best interest. They don't have an interest in protecting a bank or a brokerage or anything else. And an easy place to start to get a better yield, very safe, is Vanguard. They have very, very low expenses, usually about 0.1%. Most of the folks who run money market accounts are about 0.5%, 0.4%. Exchange traded funds also have low expenses, so you can look at those as well, that invest in treasuries, especially short-term ones. Or you can go to Treasury Direct, one of my favorite ones, and you just buy the treasuries directly from the government. So now you have no expenses, no middleman, and you can set up your own ladder. So, for example, 6-month rates are the best right now. Every week or every month, I just break my cash into that, like, 3 monthly chunks if I want to do it every month, and I buy a 6-month bond with each chunk, or 6-month bill, and I've got money maturing every month. Just break it into 6 monthly pieces, and I've got money maturing every month, but I'm always getting the best 6-month rate. And that's an investment advisor can show you how to do that. Even the banker folks can help you do that as well. So in summary, just check out your bank and ask your banker what's going on. Determine your goals and tolerances for risk. How much time do you want to spend administering this, paying attention to it? If you want to spend some more time on it because you got plenty of money and a half a point makes a difference, then go to Treasury Direct or put some money in a real money market fund, a mutual fund, or do a combination of these things and diversify all around. Now, I say a real money market mutual fund because all kinds of banks say they have a money market account, but really that is just another name for a savings account, and it's still subject to that FDIC limitation per account holder. Mutual funds, they have prospectuses. You can see what they invest in. They have a custodian who has to hold on to that money and make sure everything is working the way it was intended. So they've got some decent protection as well. And we can set up a course, maybe 2 hours if enough people are interested in it, to learn how to do this in more detail. Or if you just want to talk about it on an hourly basis, so we can set up looking at your bank on a quarterly to annual basis, let me know. But for most everybody, work through someone who really knows what's going on, a registered investment advisor who's fee only. So feel free to ask me any questions, comments.
Well, it looked like somebody might have had a question, but they put their hand down, so you might have answered it in your summary. But one of the things you and I talked about before, and maybe you can answer this a little bit more in depth, is, are bigger banks safer than smaller banks, or is it better to have a diversification in both? What are your thoughts on that?
Well, if you're a bigger bank, you will say yes. If you go talk to anyone in a big bank, they will be polite about their small bank neighbors, but they will always be sure to tell you that they are the safest. The reason why people perceive them to be the safest is because we believe that the government will never let them fail. Here's where the too big to fail comes in. So that's why most people believe that J.P. Morgan Chase, Wells Fargo, Bank of America, Citicorp, those kind of folks, and there's plenty of others, KeyBank, great, U.S. banks, there's plenty that are larger. The ones you see on the advertisements, they're probably going to be there. But on the other hand, is their service good? Do they know you? Do they know your business? Are they willing to work with you in all kinds of different ways that you need from a business banking standpoint? They're always ready to help you advise on your wealth and help you, take fees in there to help you manage your money. So you have to decide. I believe that they are so complicated, their financial statements are so complicated that no one knows what risks are really embedded in a lot of those big banks. So, and yep, the federal government probably will backstop them. So if that's most important to you, go for it. I personally believe that the smaller banks are a much better place to keep my operating funds. There's plenty of, and small is not really small. I mean, regional banks could be $100 billion. I mean, they can be huge, but like Silicon Valley Bank is not a huge bank. They weren't part of the top 25, but they're $200 billion banks. So there's plenty of banks out there that are $10 to $100 billion who are just awesome. And then there's plenty of great community banks and credit unions who are really good places to help you with your money, but they're not going to be the best place for your yield. If you've got a lot of cash that you want to keep around, then start working on diversifying that as well.
Thank you. I have two questions, and then I'm going to let Greg ask his question live. The first website that you talked about, Jim, is that the one that they go to look at their bank's health?
Yes.
Okay.
Yeah.
And then
you can look that up. If you can't read that or whatever, the easiest way is just Google bank call report, and that website will normally show up right near the top.
Okay. And I did put the links that you had in your presentation in the chat. So if anybody wasn't able to write all that down, I put it in the chat for you guys, so you can just copy paste that into your web browser. The other question that's related to the first question we had, and then Greg, I'll go ahead and let you ask your question. What about local credit unions?
I think local credit unions are awesome. I don't know how to look up their financials as well, but usually you can get their financials from them. They usually publish them online, and they are usually extremely conservative. They tend to focus on auto loans and kind of residential loans, but a bunch of them are doing more business-related loans. I consider them just like kind of a community bank. You're not going to, I mean, sometimes they pay a little bit better rate, but it's not going to be great if you've got a lot of cash. But I think most of them are pretty good, but I would still go look at their income statement and balance sheet and ask the bankers what's going on, and especially with any line items that have changed much. And if we have a few moments, I'll talk a little bit more about automobile loans and commercial real estate loans in a bit.
Okay, Greg, I'm going to let you ask your question. Go ahead and unmute yourself, and you can ask your question to Jim.
Okay, thank you, Jim. Can you hear me?
Yes.
Yeah.
Okay, great. I also put this in a chat box, but we have overnight sweeps with our lender, Regions Bank, and I'm not quite sure what it's sweeping over into, but it comes back every night or every morning, I guess. And the question is, and the yield is, I think it's like 4.65 or something like that. So the yield is good, but have you had much experience with those, or is that something that we should be concerned about when it's sort of leaving the bank and then coming back the next day? And these are they're in excess of the FDIC limits, and so I don't know if we're covered or not.
Okay, so Greg, let me summarize and tell me where I miss it. They're basically doing an overnight sweep of your money.
Correct.
And they're investing it at, did you say a little over 4%? Is that what I heard?
Yeah, it's like 4.65%. It's something it's been going up with prime, so it's linked to Fed funds somehow. And I'll get more information. It was one of the ones we never really had to worry about, and all of a sudden, with what just happened, it's like, oh, I wonder if we're covered, because it sweeps down to a minimum balance. Let's say 10 grand, and
Okay.
the next day it all comes back.
Okay, that kind of thing has actually been going on for decades, and I would talk to your banker and understand more exactly how that cash management works, exactly what it's being invested in, and exactly who is the custodian of those funds at that time. Okay, do that, because it can vary. It sounds like a great deal, and just understand that they could be investing in repurchase securities, is what it kind of sounds like to me, which is very normal. So it could be you just have a repo account set up, and that's what's going on. So you're kind of investing just the way the bank does. So as long as you're doing it with the same kind of protections the way the bank does, that's probably just fine. But I'm not sure I would go down to 10 grand, but that's up to, I mean, this is where you have to examine your tolerances for risk. Like, if you tend to have 100 grand of expenses a day, then I don't know if I'd go down to 10 grand, but that's up to you.
Okay. All right. Thank you. That's my next call, is to my lender to understand what's happening on the other side of the fence.
Yeah.
So to speak.
Just, in fact, what I would do is go where they do it. Go talk to the people who actually do it, and get to know them, and have them explain how they do it, because most of them love to do it. Now, it could be that it's not done locally. It could be it's done in New York. It could be it's done somewhere else. So see if you can get on a Zoom call with them. The more you can personally understand who's doing it and exactly how they do it, the better off you're going to know what's going on.
Okay. All right. Thank you.
Thank you for your
Sure.
question, Greg. Our next question is from Robert. How do you feel about some of the investment accounts offered by some of the big public utilities? Higher yields with check writing options, etc. Not insured, but not so economically sensitive, and thus possibly safer than banks? Question mark.
Read that. So this is offered by utilities? Is that what I'm hearing?
And Robert, if you'd like, I can unmute you so you can confirm some of the parts of your question. I'll go ahead and do that. Robert, you're welcome to unmute yourself and add to the question.
All right, I think that worked. Am I getting through okay?
Yes, you are.
Yep.
Yeah, a number of the big public utilities in our area, certainly Duke Power, Dominion Energy, they offer what's essentially what I call the private money market account. And you get check writing options. Typically, the rates are layered based on your account balance. Currently, Dominion's paying 4 3/4% on balances over $50,000. And my thought is it's a great place to park money very short term, knowing that, of course, it's uninsured. But if you need daily liquidity, you can link your accounts to it, so you can move money electronically. You can write checks. You can do pretty much anything you want.
Thank you.
Toyota Motor also does the same things. I'm not too sure if I'm too crazy about that option, but my thought is that at least with the big public utilities, people aren't going to stop paying their bills, and they're using that money presumably to meet their capital requirements, and it's a cheaper way for them to do that rather than to borrow money or to float new stock or new bond issues. So I use it quite a bit personally. We haven't started using it here at the company. I'm not too sure I'm all that comfortable with that, but it does seem like an option if you're willing to take a little bit of risk to reach for a little bit higher yield than what I think is a pretty stable environment, but perhaps not.
I think it's a really interesting idea, and just the way you're approaching it makes perfect sense, Robert, that you're doing it with this, maybe not all of your personal checking, et cetera. But what that's telling me is that I would go evaluate the financial condition of that utility company. And now I've got to because they're the ones who really is backing it. And some of them have great credit ratings. So, and some of their credit ratings are way better than banks. So you're right. It could be that's just fine. I think it's a great thing to consider. If I had a lot of cash that I wanted to invest, though, I still can't find something that's better than going directly to the Treasury. That's all.
I agree. I know I've got between I bonds and 2-year treasuries. Those are the kind of things
there you go.
I put out a couple 2 years out. But if I want to keep money handy for a new car or something along those lines, I typically like to have something a little more liquid.
It sounds like you're paying attention to this great, and I would love for you to co-teach this course next time. I mean, it sounds like you're really, understanding the different risks and what you want to do with your money and laddering it out over time, and that's great.
Well, that's good. I appreciate it. Thanks.
Sure.
Thank you for your question, Robert. The next question comes from Ryan. How do you feel about fund money market accounts provided by companies such as Fidelity, 4.66% yield, risky or safe, and covered by any government insurance?
And who's providing these again, Emma Jane?
He said Fidelity with a 4.66% yield.
I would just read the prospectus. Fidelity is a great one. Vanguard to me is a little better because they tend to be lower cost. So I would look at what Fidelity's giving you for 4.66%, and what their expense ratio is on it, just so you can understand it. It sounds to me like they're probably taking a little bit of yield or a little duration or a little bit of credit risk to give you 4.66 because but it may be fine. Maybe just fine. You just have to look at what they're investing in, how long they've been doing it, and what that operating expense ratio is. But I think if you don't want to do Treasury direct, the money market mutual funds are a great diversification tool for everybody for money over and above what you have in a bank. And Vanguard and Fidelity are some of the best managers out there and longest running.
Excellent. Thank you. I hope that answers your question, Ryan. Feel free to post a follow-up question if you have anything else. Dave?
And regarding some of this, realize I am no longer a registered investment advisor. I'm doing this for education purposes. So if you really want advice on exactly that kind of question, please go to a registered investment advisor, because I'm really not qualified to do that anymore.
Exactly. I was going to make sure to mention that at the end of the webinar as well. That
okay.
We're just
Thanks
here to give you some thinking points that you go take to the experts to make final decisions. But the purpose of this is for Jim to give you ideas of what to look for, questions to ask, and place resources that you can go to get answers to your questions, and really kind of start a conversation about how to keep your money safe.
Yep.
Okay. David, we do almost exclusively CP cash. The FDIC guarantees up to $250 per account per depositor. We have significantly more than that in several banks, as well as customer escrow accounts for a lot purchase and construction agreements. Is there a strategy or place to put large amounts of cash that would be protected, short of opening 60 accounts in 60 different banks?
I personally like the money market mutual funds, or going direct to the Treasury, or having an investment advisor do that, manage that for me. That's what I would consider.
All right.
Any funds that you you have a good idea as to when they're going to be needed, like it's 3 months from now or 6 months from now, or it's relatively indefinite, but it's more than a month, you probably could get a better yield and do it simply. Feel free to talk to your bank about if they have options available for them to do that for you, to administer that for you, because some of the mid-sized banks and all the big ones have the ability to do that. But if you want to do it more yourself, then the mutual funds are great, and Treasury Direct is my favorite because it's really easy to do.
And this is more of a comment, I believe, Brian, for Greg. Their sweep automatically pulls from the investment account as needed for payments and sweeps the excess deposits in excess of 10K daily. So I think 10K is appropriate if yours is set up the same way. So those were some thoughts on Greg's question. And Robert had a comment about the Treasury Direct. He says, one caveat regarding Treasury Direct, you cannot sell the bonds through the site. You have to transfer them to a regular brokerage account in order to sell them prior to maturity.
Absolutely correct. So thanks for bringing that up, Robert. This is for people who have some relatively stable funds that they want to continue to keep liquid. Because if you want to sell it early, yes, that's correct. You have to take it to a broker and then have them sell it. So it's usually a good idea to have a brokerage account. And there's many discount brokerages that you could open the brokerage account with, and then just buy the treasuries through the brokerage account, and it's very low cost as well. So if you think you might want to do it, need the money at some point, then before it matures, then start buying a chunk of that through a broker. And most of them are not charging a whole lot. Their fees to do treasury bill and note purchases are very low. And you can negotiate them too. So if you got a lot of money, you get a really low fee.
And that's the conclusion of our questions at this moment. I just want to, we'll go through a couple more slides. Oh, I have one more question. Myrna would like to know, would something like TD Ameritrade be a brokerage account you could use for a Treasury Direct thing?
Well, you wouldn't. They would buy the treasuries for you, so you wouldn't be going direct. But you could. TD Ameritrade is great. You could use them to buy the treasuries. Just talk with them about it and see how to go about it. You could also invest in any of the money mutual market funds through TD Ameritrade as well, or exchange traded funds. So I would talk to them about it. They're a decent brokerage firm for sure. Charles Schwab's good. TD Ameritrade's good.
Excellent.
I can think of a couple. I like Interactive Brokers myself, but that's up to you. Let me just add one other thing, Emma Jane, on automobile loans and commercial real estate. So what's happening because of all these depository issues over the past few weeks is that all banks, but especially the smaller the banks, are becoming tighter in their underwriting standards. They're also wanting to raise their liquidity, so they're not investing in loans as much. They're trying to keep more cash on hand just in case some of these uninsured or insured deposits need to leave their bank. Consequence of that is that lending to folks in our business is going to sharply decline. The credit standards are going to decline quickly. Some banks may say, look, we love you, but we can't make new loans for a while because we got to build up our cash balances. So there's going to be some reverberations of this happening over the next several months that are going to cause the lending to our industry to maybe even dry up, but definitely have some volatility from 1 month to the next. And when you're looking at your banks, you want to see if they have a high concentration in automobile loans or commercial real estate loans, because those are likely to have the highest loan risks over the next couple of years. Commercial real estate, unfortunately, has all kinds of things that fit into it, including our loans on house construction loans, land loans, and those aren't as risky really as office space right now. Office space has a lot of high vacancy rates. The retail space is doing okay. So that's where you want to, if your bank has a lot of commercial real estate loans, go ask them what they're doing about it, what kinds of loans they have. Okay.
Thanks, Jim.
And that's just more come up since I did this presentation a couple of weeks ago. So it's happening rapidly, these changes.
Yep. And our hope for particularly this topic is that we've created an environment where we can have a conversation about these topics and these issues and have you prepared for when you talk to your financial advisors or your banks or some of the other experts in this industry, so that you make sure that you come prepared and educated to the table instead of not knowing even what kind of questions to ask. So that's really the purpose of this presentation today. If there's anybody, feel free to, I'm going to go through a couple slides as a closing, but feel free to ask questions if you think of anything. We're not closing down quite yet, but just a couple of reminders of other things that we have coming down the pipeline. So many of you have been having struggles with cycle time and scheduling, and so we added this seminar coming up on April 20th and 21st in Denver, Colorado, our Scheduling for Profit seminar. So you guys, we can give you tools and ideas to help you bring that schedule back in line. This is going to be very important, especially with interest rates rising, making sure you're getting those turns, more turns in the year than you are at this moment. You can switch the slide, Jim.
Okay. Try again. Okay.
There we go. We have several different services that are always available to you. Our rebates through builder partnerships, if you're using, and we'll have a slide with the different companies that we have partnerships with. We're happy to help you with those rebates and get extra money in your pockets. Obviously, we have training, consulting, and coaching available for all of our friends and family, so to speak. And we offer that online and live classes, and we also offer in-person and remote consulting. A couple of things that are often go missed is one is our surveys that we offer, where we survey your trades to see how you stand up against the concept of builder of choice, being the one builder that the trades want to work with in your market, so you can avoid the whole trade shortage and improve your relationships and with your trades. And then we also have our builder groups. We do have a few spots left in our builder groups. This is our support group for builders, where you can have conversations like this. And actually that's where this presentation came out of, was from a builder group discussion where we realized really the insecurity that some of the builders had on this topic. And so we wanted to bring it out to the rest of our group of people that come to our webinars. You can go ahead and switch slides. Here's a list of the different vendors that we have partners with, that we're partnered with. So if you're using any one of these vendors, please feel free to contact us at info@builderpartnerships.com, and we can help you get set up so you can start getting your rebates. And of course, our consulting team is on staff for you to help you with anything that you're looking for, from help in production, cycle time, estimating and purchasing, to leadership, to governance, to setting up different divisions or segments of your organization. Jim's an expert in those kinds of things as well, so feel free to contact us if you'd like to schedule any time with Jim or any of our other consultants. And here's our schedule for the remainder of 2023. We have our Scheduling for Profit coming up at the end of April. And then we also added a second superintendent for the spring season in May in Raleigh, North Carolina. And then we'll kick off the fall season in October with another superintendent and Managing for Profit, closing down the fall season with a production management seminar here in Denver, Colorado. And obviously take a look at our online classes as well. If there's anything that you're wanting to see, feel free to always email us or text us, call us, whatever, and we're happy to add anything to the schedule if we have some interest in that. Oh, and next week, join us next week for our webinar Wednesday. It will be on Wednesday next week with marketing strategies for product pricing adjustments. Ed Hauk and Brad Bombardier will be having a discussion on how to take advantage of new product development and how to market that in the industry and how to focus on pricing. And with that, we're all done for today. Thank you so much for your questions. I feel this was a great conversation. I hope you guys feel more prepared to talk to your bankers and your financial advisors, and even discussions within your management team and your leadership moving forward. And if you have any questions, Jim's information is right here. He's at jim@finconsulting.com. And we look forward to seeing you at the next webinar Wednesday. Have a great day, everybody.